Okay, so now recording, I'll do, this is chapter 12, reviewing multiple choice and short answer problems, odd questions only, and that should be it. So this begins on page 27 of chapter 12. I didn't do any kind of a video going through just in general chapter 12. Yeah, I think based on what's likely to happen for the fall, we're probably going to be doing some sort of blended classroom. Who knows? It's still well up in the air, but I know I'm going to have a monster amount of pre-recorded videos for both face-to-face and online classes that covers just my walkthrough of the chapter and then going through practice work and some homework. So there's going to be I'll be recording a lot in the rest of May and June. I hope to have it done by July, so I get a couple weeks off. So anyhow, so we can have more of a semblance of a face-to-face class. We'll see. Who knows? Still up in the air. Anyway, chapter 12 is a good just review of what the IRS does and what they don't do, when they charge penalties, how the process works. The IRS is a very large organization, and it's scattered out across the countryside. Some of the IRS components are scary, others aren't. So, you know, it might not do you harm to kind of just take a quick walk through to get an idea of what the IRS really is, what the penalties are, you know, what are the rules, so to speak, the rules of the game. Most of the time, all we hear about is the terrible things that they can do to you. Well, yeah, they can. They don't like to do that. They'd much rather collect your money. They don't want your stuff. So, much like a banker. Anyway, on page 27 of chapter 12, let's just begin. Let's just begin going through the multiple choice questions. Item 1, which of the following is the responsibility of a local office of the IRS? The local office, and I know we have an office in Milwaukee. I don't know about Madison. I think we have a Madison office. But if you walk through of them, advising the Treasury Department on litigation, on legislation. Now, the local office doesn't do that. Intelligence operations, you know, like some sort of sting thing. Yeah, that's not them either. Appellate procedures, and that's a higher court thing. They don't do that either. Developing IRS rules and regulations, that's also not done at the local level. So letter E, none of the above. The local office is really more about information and enforcement. That they're there to help the taxpayer with questions, and they're also part of the enforcement arm. But they're really not part of management, so to speak. It's a lot harder to get onto a first name basis with an IRS agent than it used to be. Yeah, not sure why. But if you can find one that'll take your call, if you can find an IRS agent that will accept your phone call or respond to your emails, that's a valuable asset. So for those of you keeping score, number 2, the correct answer is letter E. Number 3, which of the following is the most common type of audit? And you know, it's a particularly difficult time of year for those of us who suffer any kind of allergies. The trees are in full bloom, lots of pollen in the air. So anyway, the most common type of audit is a correspondence audit, letter B. You know, they don't often come to your business, come to your house, come to your accountant's office unless they have to. You know, they don't want to travel. So if they can get the questions they answered that they need answered by mail, that's where they'd rather do it. I think I've had a couple of those over the years on my personal return where they've just sent a letter saying, hey, send the stuff that supports these numbers. And so you send that stuff in, and it's either fax or they will accept emails now. And then you never hear back. Anyway, so that's but it's the most common type of audit out there is the correspondence audit. They're not going to call you. So they don't, you have the opportunity to call them. When you get a letter, they've got a phone number there. You know, it's kind of like calling the Department of Workforce, whatever, you know, the, what is that? The unemployment office here in Wisconsin. And that's a day-long wait. So yeah, don't do that. So calling the IRS is not much better, but they're not going to call you. And you should know that by now. I mean, that was a telephone scam that went on for a few years. You know, where, you know, I'm calling from the IRS and we're going to put a lien on your house unless you go to Walmart and buy some gift cards. It's like, what? So the IRS does not accept gift cards as payment. So you know, if you bought into that, then yeah, you should get ripped off. So it's anyway. Number 4. Yeah, if you're taking score, that's letter E. Number 5, which of the following is not a penalty that may be imposed by the IRS? Well, these are all listed out in the chapter. Failure to file. Yeah, if you don't file a return, they'll charge you a penalty for that. What if you don't owe any taxes? What if Gary's Guitar Shop Inc. and they file a 1120? I'm showing a loss. I don't owe any tax. I have no refund of anything. There's really nothing happened, and I don't file a return, or I file it way late. Is there a penalty? Yeah, but it's not big. It's like $50 or something like that. It's not a big penalty. They don't charge you a fortune. Now, when do they start charging you money? Well, if you don't file and you owe them money, then yeah, then the interest starts clicking. Anyway, so failure to file, there's a penalty for that. Failure to pay, yep, there's a penalty for that. Negligence. Now, this is when they're really mad at you. They don't want to go this far. They don't want to, because negligence is kind of hard to prove. That you were willful, that it wasn't just a mistake, that you did it on purpose. And then, so yeah, there is a penalty for that. But that's usually after you're already in a fight with them. They don't just all of a sudden send you a letter saying that there's a negligence penalty. Unless you ignore a bunch of letters, then what they'll do is it's really the velvet hammer. They give you a get your attention letter, where they're going to tell you all the terrible things they're going to do to you. That just means, hey, you know, get back in touch with us, will you? So yeah, that's how that works. So letter D, early filing penalty. Yeah, there's nothing like that. If you want to file your 2019 return on Valentine's Day of 2020, yeah, they don't care. There's no penalty for that. So letter D is the one that's not a penalty. Number 6 is letter B. Number 7. Remember, the book is a year old, but there is typically a 3-year waiting period that the IRS can go back and look at a return that's 3 years old. And so using number 7's information, 2018 return filed on March 3rd of 2019, you know, when does the statute of limitations run out? Well, 20, 21, 22. So it's going to be 2022, the 3 years runs up. But the question is, what day? When does the clock actually start? And the clock starts the later of filing or due date. So they filed early. They filed in March, but the due date is in April. So the clock doesn't start until the due date. Now, what if you file after the due date? Well, the clock starts then. It's always the last day. The last possible day is the day the clock starts. So if you extend your return, you're not getting more time. The clock doesn't start ticking until they get your return. So what if you don't file your return for 3 years? Well, guess what? You gave them another 3 years. So there's no way to scrape off any time other than to file your return so that the clock starts. Now, it won't start early. So if you file your return on January 2nd, that's not when it starts. The clock will start on April 15th. This case, the clock doesn't start until July because the Congress extended our due dates out to July 15th this year. Number 8 is letter D. Number 9, which of the following taxpayers may not represent clients in IRS tax court? Now, an enrolled agent, we talked about this a little bit in tax 1. An enrolled agent, you might see the letters EA behind some tax preparer's name. They've completed a 3 or 4 part test that's monitored by the U.S. Treasury Department. It's not an easy exam. You don't have to have any specific education requirements to take the EA exam. So if you don't have an accounting degree or if you don't have a law degree, but you want to do taxes and you want to have some letters, the EA is the route to go. Now, if you show up at a tax seminar, like the ones that I go to in November and December, and there's going to be a bunch of CPAs there, there's going to be a bunch of attorneys there, but I got to tell you, the EAs get just as much respect. So it's not like CPA light. EAs are very qualified tax preparers. So for those of you who are interested in taxes moving forward and you'd like to get some letters, but you know you're not going to get a 4-year degree, then start working on that EA test. So yeah, there's no education requirements for that. Anyway, enrolled agents, CPAs, just by virtue of me having a license, and it's a good license, I can represent clients in front of the IRS. Now, I don't want to, but I could. An attorney, yeah, if you are a member of the bar, then yes, you can represent tax clients in front of the IRS. Letter D is correct, all of the above. Number 10 is letter C. Number 11, which of the following does not result in a minimum $50 fine for the income tax preparer? Now, the way people commonly read this is when they say not result in a fine, they mean in any fine. Now, what they mean by this question is there might still be a penalty, but it's not a $50 penalty, and that's the way you should read this. Failure to provide a tax preparer ID number. Yeah, that's only 50 bucks. So if you forgot to put your PTIN on there, they'll ding you 50 bucks. Now, it's a problem if you did 1,000 tax returns, then yeah, it'll be expensive. Now, cashing a refund check for a customer, really bad idea. The penalty is more than 50 bucks, but yeah, you should not be having refund checks mailed to you. That you should not have your name on the refund check where you have it, where you have it made out payable to you and the tax client. You do not want to cash them. Yeah, this is really, really bad. Now, there are some tax preparers out there whose ethical compass is a little off, that this is how they got paid. They would say, well, we'll just take it out of your refund. And by the way, I'm having the refund check mailed here. Well, okay, so that's a tax client that is a little iffy anyway. Yeah, you don't want those. If they can't write you a check when you give them the return, then yeah, that's a problem. Letter C, failing to keep any record of the returns prepared. You don't need to keep any of the client's details like their W-2s and 1099s and stuff, but you should keep a list of the clients that you did returns for. You don't even have to keep a copy of the return, but you should just keep a record of the clients you prepared returns for. And then failure to provide a copy of the prepared return to the customer. Yeah, I could see where in today's electronic filing world that this could happen. But yeah, you got to get a copy of that return to your client. Letters A, C, and D result in 50 bucks per occurrence. Letter B is more than that. I think it's over 500 bucks, something like that. So letter B is the correct answer. Number 12 is letter C. Number 13, which of the following have privileged communication with a client in a non-criminal tax matter? So where can you claim, like you see on TV, well, that's client attorney privilege or client doctor privilege or whatever, patient doctor privilege, or the seal of the confessional, all those kind of things, where I know but I can't tell you. Yeah, so as a matter of fact, all three of those do have that privilege between them and their tax clients in a non-criminal tax matter. So letter E is correct. Number 14 is letter D. Number 15, the IRS does not have to furnish the taxpayer with information concerning which of the following items. Well, let's look at the ones that they have to tell you about. We'll skip the correct answer, letter A. Letter B, the procedures for appealing the IRS. They have to tell you how you can appeal. Letter C, the refund claims process. They have to tell you how that works and how you can use it. Letter D, the IRS collection process. They have to give you how that works. Letter E, all of the above doesn't work because letter A, the way the taxpayer's return was selected for audit, they will not tell you that. They tell you that there are no red flags, that if you have 3 or 4 of these red flags, like a home office deduction and a loss on your Schedule C, and 5 rental properties that are showing losses, and that kind of stuff, that's not a red flag. Well, yeah, those of us who prepare returns say, yeah, that's BS. There are, and clearly in this world of big data, they are using algorithms to come up with who they're selecting for audit. So if you've got a fairly simple return, a couple of W-2s and 1099s and whatnot, your risk of audit is very low. That doesn't mean you just don't get pulled out random and they just ask you for some information. That does happen. But if you got a simple return, the chances of you getting audited are pretty slim. Why? Well, because they don't want to spend time where they can't get anything. So they want to devote time where they think they're going to realize some additional tax money. So letter A is the best answer. They're not going to tell you how to beat their selection process. Number 16 is letter D. Number 17, taxpayers' rights are explained in publication 1, which is actually on page 20 and 21 of this chapter. This is the Taxpayer Bill of Rights. I think this started up maybe 15, 20 years ago, when the IRS was a lot more secretive and pretty much a lot harsher. I'm not saying that they're wonderful people now, but they're a lot easier to get along with. So that's publication number 1, is the Taxpayer Bill of Rights. Number 18, letter D. Number 19, if a U.S. tax court agrees with the taxpayer on appeal that the IRS position was largely unjustified, which of the following is correct? It's going through the IRS, going through the tax court system is not cheap. And so the IRS sometimes will kind of bully a taxpayer into paying by saying, well, of course, you're free to take us to court, but then you have to find an attorney or an accountant or both to spend a bunch of their time representing you in court, and it gets to be very expensive, and then you still might lose. And so then you have to pay the IRS, and more penalty, more interest, more taxes, and your attorney and your accountant. So oftentimes the taxpayer will just cut their losses and say, yeah, all right, I don't agree, but I'm just going to write you the check to make this go away. Yeah, happens every day. But if you've got the money and the time, and you think you've got a strong position, you will be, letter D, eligible to recover some of the administrative and litigation costs. The taxpayer must have tried to resolve the case administratively, which means negotiate a little bit, including going through the appeals process, and must have given the IRS the information necessary to resolve the case. So what they're saying is that as a taxpayer, I can't just say, heck with you, I'm not going to give you any information, and we're going to go directly to appeals court. Yeah, that's not going to work. The tax court says you have to play ball up until when we say that you're right. Then you can recover some of the money back that you spent. So that's letter D. Yeah, if you can resolve the issue without going to court, even if you don't agree, as long as it's not, you know, thousands and thousands and thousands of dollars, just write the check, let it go away. Number 21, Glenn's taxable income. When they start giving you data, I just want to see what they're asking. What is Glenn's marginal tax rate? Now, if you don't remember what marginal means in this case, it means what is the rate that will be charged on the very next dollar. So remember that our personal taxes are still a graduated scale, that there are tax brackets. As you go higher in the brackets, the rates go higher. And so what they mean by marginal rate, what is the highest rate that you're paying on that last dollar? Well, they gave us two ranges. They gave us the taxable income and the tax at two different levels. So all I have to do is do the math. So we take 60,000 of taxable income and subtract 50,000 of taxable income to see that that range was 10,000 bucks. Then we take the tax for both of those, 9140, subtract out 6940, and we end up with, well, that additional $10,000 of taxable income cost us an additional $2,200 in tax. So let's do the math. 2,200 divided by 10,000 is 22%. So the marginal rate is 22%. Now that's not the average rate. The average rate would be take the entire amount, like the 60,000, and the tax on that, 9140 divided by 60,000 would be the average rate. We're looking for the highest rate they're in, the marginal rate. That's letter B. Number 22 is letter C. Number 23. This is, we should have spent a little more time on this one, but this is figuring out what is your after-tax benefit. Now this is assuming that Jim can itemize. If Jim can't itemize, this doesn't fly. But if Jim can itemize, you would take the $17,000 that's deductible. He's in the 30% bracket. So that's going to reduce his tax by 30% of $1,700. So when they say is what is his after-tax cost of the house? Well, I took the $1,700 and multiplied it by 1 minus 30% to say this is my after-tax cost. My after-tax savings cost is really 70% of that. So $1,700 multiplied by 1 minus 0.3 is 1,190. Then add in the $300 that is the principal reduction, because there's no tax benefit to a principal reduction. And you add that together, you get $1,490, letter C. There is an example of that late in the chapter. And it's good to know how to calculate the after-tax yield on stuff. So that's what that is. What is your after-tax benefit? So he spent $2,000, and after tax, assuming he can itemize, the real net cost was just under $1,500. That's why people like rental property, because they can get a full deduction for their interest, all the maintenance, all the utilities that they have to pay versus the renter, depreciation and whatnot. So they get a pretty good after-tax benefit. The only time that they lose that is when they go to sell the property. Then they have to pay it all back. A lot of it anyway. Okay, so that's it for the multiple choice. So let's take a quick walk through the short answer. There is some calculation here, and I'm not too worried about that. But anyway, indicate which of the following statements are true or false. This is item 1. The IRS is a division of the Treasury Department. Yep, that's true. IRS has 4 major divisions. No, they don't. I can't remember exactly how many, but I know it's not 4. IRS local office process most individual tax returns. No, the local offices don't process returns. They're involved in information and enforcement. IRS campuses processing sites are the locations that taxpayers should call. No, you don't call your processing site. You call the local office. Taxpayers should have their CPAs keep their tax records to prevent the IRS from being able to summon their records. No, that doesn't work either. It's your tax records are your records. So where I work during tax season, we keep an electric copy of everything we get. So all the W-2s and 1099s and brokerage statements and whatnot, we scan and save all that. We give all the paper copies back. We don't want that stuff. Now, why do we scan and save it? Well, in case there's a question next year, or in case the IRS wants to audit the return, and what happens then is that the taxpayer will always blame the preparer that says, well, what did you do wrong? Well, we didn't do anything wrong. Here's the information you gave us, and we put it on the return. So if you didn't give us the right information, it's not our problem. So I got a family member that I do their return, and they like to gamble, and they always forget about their W-2Gs. Now you get those when you win, and you're not going to get another one in January of the following year. So let's say you win something in April and you get the W-2G from the casino that day. You've got to keep track of that until your tax return is prepared next January. If you don't, guess what? The IRS does get a copy of that, and they don't forget about that. And within 2 or 3 years, you'll get a letter. I think it's like a CP 2000 letter that says, hey, you know, we got these W-2Gs from Ho-Chunk, and we didn't see it on your return. Pay in the tax. Oh, okay. So that's why we keep track of all this stuff. Here's what we got from you. Didn't include the stuff that the IRS had. Not our fault. Oh, well, we'll fix it for you. You know, we'll charge you another $300 an hour. So that makes them even happier. But you know, we tell them, nope, it's your fault. But we'll help you fix it for $300 an hour. Oh, okay. Let's see. And then the final one, most IRS audits are conducted through the mail. No, well, yes, they are correspondence audit. So that's true. We got true at the top and the bottom, everything in the middle is false. Number 3, this is a 3-part question. Wilson files his individual tax return on the original due date, but failed to pay $700 in tax that were due with the return. If Wilson pays the taxes exactly 2 months late, calculate the amount of his failure to pay penalty. Well, the failure to pay penalty is a monthly rate, and it's a 0.5%. It's 0.5%. But if you take a 0.5% per month, you know, that ends up being 6% a year. So anyway, it's $700 multiplied by 0.5%, which is 0.005, and then multiply that by 2 months, and you get $18. Yeah, and you get $7. Letter A is $7, so it's $700 multiplied by 0.5%, 0.005, and then multiply that by 2 months. They don't charge you by the day, they charge you by the month. Letter B says, Joan filed her individual tax return 4.5 months after it was due, and so that's late. She did not request an extension of time for filing. Now, some people don't realize 4.5 months. It's April is the 4th month, but we're halfway through the 4th month, so that's 3.5 months. 4.5 months means she filed it on May 15th. She did not request an extension. Yeah, okay. Along with her return, Joan remitted a check for $750, which was the balance of the taxes she owed with her return. Disregarding interest, calculate the total penalty that Joan will be required to pay, assuming the failure to file was not fraudulent. Because if they think it was fraud, they really get mad and they charge a much larger penalty. All right, now the IRS and most tax software will calculate this for you. But there's 2 things here, failure to file and failure to pay. So the failure to file is based on, well, let's do the failure to pay first. The failure to pay is the same 0.5%. So it's 0.5% multiplied by 750 multiplied by 5 months after it was due. Okay, 4.5 months after it was due. Okay. So instead of April 15th, she filed was 4 months after, 4.5 months after that. So she was way late by 4.5 months. That means the IRS is going to round up to 5. So it's 0.5% multiplied by 750 for 5 months. And so that adds up to, or calculates out to $18.75. Now that's just a start. Now the failure to file penalty is 5% of the tax due for 5 months. So it's a very similar calculation, but they moved the decimal point over to the right twice. So it's a much larger number. Instead of $18.75, it's $187.50. And then for some reason, they give you credit back for the failure to file penalty because it's the larger of the two. And so they subtract out the $18.75. So if you add, and I don't know why they do that, it's really the larger of the two penalties. So let's say your failure to file is $18.75 and you had like $2 of tax due. Well, then yeah, your failure to file penalty would be larger. So in this case, the total penalty would be the larger of the two, $187.50. It's a little convoluted to how they calculate it, and I understand it, but you got to go through it a couple of times. Letter C says,
Gary, what was the amount again?
$187.50.
Thank you.
Not a problem. Letter C
What was
says,
that? It cut out.
oh, $187.50. 187.50.
Thank you.
Not a problem. Here to help. Letter C, Jack filed his tax return 2 months and 3 days late. He did not request an extension of time to file. Jack's return indicated that he is to receive a $50 refund in taxes. Calculate the amount of Jack's penalty for failure to file his tax return on time, assuming the failure to file was not fraudulent. In this case, other than a business return, in this case, there's zero penalty. If the taxpayer is entitled to a refund, there's no penalty. Actually, the IRS should send you a thank you note saying, thanks for letting us keep your money longer. Okay, number 5. This is where this is the scary ones where, it's negligence and fraud and yeah, bad news. Again, the IRS won't go this route unless they're really mad at you. So try to keep them generally happy because they will pull the negligence card if they want to. Linda underpaid her taxes for the current year by $4,000 due to negligence. Calculate Linda's accuracy related penalty for negligence. Yeah, I don't know how. Yeah, again, it's even if you just forget some W-2s, which is, to me, that's negligence. But if the IRS sends you a letter and says, hey, it looks like you forgot some W-2s, here's what we calculate for your taxes, penalty, and interest, write us the check, and you do, yeah, no problem. But what if you get huffy with them? Oh, okay, we'll make it really big now and say that it was negligence, because who forgets that they got a W-2? So it's, anyhow, yeah, so don't get huffy with the IRS. So the negligence penalty, I think, is 20%. So if she has $4,000 due, you tack on another 20%, and they said, don't worry with calculating the interest. That's $800. All right, well, maybe that's not a big enough number. What if Linda says, well, I worked for him, but I worked for him for cash, and I wasn't going to pay the tax. I was clearly trying to defraud the government, and I'm being huffy with you, so you do your worst. And the IRS will say, well, you knew it was taxable, you left it off your return on purpose, you defrauded the government, we're going to charge you now a 75% penalty. So $4,000 multiplied by 75% is $3,000. So that's the fraudulence penalty. Yeah, don't do that. Man, I love the people who think they can fight the IRS. I mean, that's a losing battle. Now, you might be able to win in court. You know, if you think you've got a good position, you might be able to win in court. So, but you can't intimidate them. They won't back down. Number 7, which of the following statements are true or false? Tax law includes a penalty for writing a bad check. Yeah, it does. If you pay your taxes with a bad check, there's a penalty for that. You don't do that. Statute of limitations is normally 4 years. Nope, it's normally 3. That's false. If a fraudulent tax return is filed, the IRS may assess the deficiency at any time in the future. Yes. Here's the thing, that 3 years, that all bets are off if they suspect fraud. If they suspect fraud, that 3-year time does not matter. They can go back to the beginning of time if they want and charge assessments and penalties and taxes for you until the first return you ever filed. So that's why you definitely do not want them to think that you are involved in any kind of fraud, because that 3-year statute of limitations goes away. So yeah, don't do that. Then the last one on the bottom of page 31, enrolled agents work for the IRS. That's a pitch in the dirt. The word agent, yeah, no, they don't. They're a professional tax preparer, similar to CPA and attorneys. A commercial taxpayer, you know, like Liberty Tax, H&R Block, that they're not a CPA, they're not an attorney, they're not an enrolled agent, may represent tax clients in any proceeding with the IRS. No, they can't. Unless they're an enrolled agent, unless they're a CPA, unless they're an attorney, or any combination of the above, they cannot represent the client, any tax client in front of the IRS. So you could be a professional tax preparer, so to speak, with Liberty or National or H&R Block, and you could be brilliant at it, but unless you're an enrolled agent, a CPA, or an attorney, you cannot represent that client in tax court. The last one, the IRS is entitled to choose a place and time for an audit without regard to the inconvenience to the taxpayer or the reasonableness of the request, and that's false. They have to be somewhat reasonable as to where and when the audit is. When my mom still lived on the farm, you know, she took some fairly aggressive stances on some things with the IRS, and she would call and ask my opinion, and I said, don't ask me my opinion, because I'm disagreeing with your tax treatment. But I said, if the IRS ever contacts you and asks for want to do an audit, do not let them on the farm. You know, it's be sure to have that audit done in the tax preparer's office. You know, so that they had a major hobby in that they were heavily involved in horse showing, and that's just a money-eating machine. And she deducted a lot of that cost, and it was clearly a hobby. So I said, if those guys come out here and they see your indoor horse arena that you're calling a machine shed, then yeah, you're in deep trouble. So don't let them out here. Number 9.
Can you go over number 7's answers?
Sure. True, false, true, false, false, false. TF, TF, FF. Number 9. Which of the following situations indicate the amount of the penalty that would be imposed? A tax return preparer, that's us, understates the taxpayer's tax liability with a frivolous, which means unsupportable, position, and does not disclose the position. Well, it depends. It starts at $1,000 and could get bigger. So the answer key says $1,000 or more. And what they mean by that, it says the greater of $1,000 or 50% of the income derived by the tax preparer for the undisclosed unrealistic position. You okay? Letter B, a tax return preparer fails to furnish his or her ID number. That's $50. Now again, that number sounds small, but if you write a lot of returns, it could be a lot of money. The tax return preparer aids a taxpayer. And I had to read this 2 or 3 times before I saw the T in understating. I kept reading it as understanding. And I thought, how is there a penalty for me helping somebody understand their liability? It's like, oh, I had to circle it, understating a tax liability. Yeah, okay, that's not good. That's a $1,000 penalty. Now, understatement means that you're making the number small falsely. Now, our job as tax preparers is to advise our clients as to how they can pay the minimum amount of tax legally due. But if we just forget to record some income in order to understate their taxes, or let's say we overstate a bunch of expenses in order to have larger deductions and therefore lower tax rate or lower tax bill, then yeah, we can't do that. Letter D, a tax return preparer endorses and cashes a client's tax refund check. Well, the answer key says this is $520. It seems like an odd number. You know, I don't know exactly what it is. It says it's from Learning Objective 5. So let's go back to that. Prepare penalties. Well, it says on page 1217 near the bottom, a goofy number, $520 for endorsing or cashing a refund check issued to a taxpayer. What did they do? Flip a coin on that? What? Why would it be 520? I don't know. Then number 11, taxpayer bill of rights. And the reason they call it the bill of rights is because there's 10 of them, which is like, you know, the Bill of Rights to the Constitution. So name 4 of those rights, and any 4, I don't care, but they're all listed on page 20 and 21. And they're summarized on page 20. Right to be informed, the right to quality service, no more than the correct amount of tax, the right to challenge the IRS, the right to appeal, right to finality, so where the IRS finally says, okay, we're done. Got a family member who was in some deep trouble from their own stupidity with the IRS. They run a small business and they just did not pay in their payroll taxes. Man, you can't get much worse than that. They got in deep trouble with the IRS, but their business has just been junk. I have no idea how they survive. And every couple of years, the IRS will contact them, come see them, and they'll say, hey, we don't have the money to pay you. And so something that I didn't realize existed, that after 10 years of trying, the IRS will often just give up and just say, yeah, okay, we're done. We're not going to try and collect anymore. It's like trying to get blood out of a stone. Well, that's what happened to these family members of mine this year. And the guys I work with in Madison, we all said, well, I've never seen this happen before with payroll tax. But, you know, what do you do? Anyway, the right to finality, which is what I think was happening here, is that the IRS realized that we can keep beating on this horse, but it's going to still be dead, so we might as well move on. Right to privacy, confidentiality, retain representation, fair and just system. So any one of those, any 4 of those items are a correct answer for number 11. You know, I've said in class over and over again that I really enjoy preparing returns now. I didn't like doing them in